Okay, I think we're going to go ahead and get started now. We've got a lot of ground to cover today. So hello everyone, and thank you for joining us today for the third and final session in Venable's virtual payments bootcamp. Today's session will cover popular and evolving payments business models. My name is Evan Minsberg, and I'm joined by Nicole Ibbotson of Incom, Dan Chandry of MindBody, and my colleague here at Venable, Andy Arculin. So first, a couple quick house cleaning items. Today's session is eligible for CLE credit. The code for obtaining CLE credit will be given during the presentation. Feel free to also submit questions to the panelists using the Q&A function within the webinar platform. We may not be able to answer all of your questions live during the presentation, but we'll be happy to follow up with answers once the webinar has concluded. Okay, with that out of the way, let's meet our panelists. So could each of you guys give a brief introduction to yourselves and your company, starting with Nicole, then Dan, then Andy.
Hi there, it's Nicole Ibbotson. I've been with Incom for over 10 years, General Counsel for Financial Services. I'm also the Chief Privacy Officer. Incom does a variety of things. We are a payments company first and foremost, but we got our bearings with gift and wireless back in the day, 25 years ago, and have expanded to a variety of products, both card products, open loop, GPR, debit, and then a variety of different money transfer programs as well, reload, bill payment, merchant payment, alt pay, and many others. I'm glad to be here.
My name is Dan Chandry. I head up payments and financial services at MindBody. For those of you not familiar with MindBody, we are effectively a software operating platform for businesses in the wellness industry, stretching from boutique fitness, such as yoga and Pilates studios, to salons and spas. And we have a large ecosystem, both of operational software and then direct to consumer booking opportunities for those consumers to book into wellness businesses.
Hey, good afternoon, everyone. My name is Andy Arculin. As Evan said, I'm a partner at Venable in our financial services practice. I've been doing consumer credit and financial services for about 12 years now. I've had a stint as a litigator. I worked for the CFPB for a few years and then joined Venable in 2015. And my practice really centers around fintech, consumer lending, everything from transactional work, forming strategic agreements, consumer contracts, to investigations and enforcement and so on down the line, largely centered around what's called the alphabet soup of federal regulations, but also an increasing amount of state and, like I said, contractual transactional work.
All right, thanks everybody. So moving right along, here's our agenda. Today we're going to be focusing our time on three business models in the fintech and payment space: B2C distribution, marketplaces, and buy now, pay later. In addition, if we manage to get through all of that, and we've still got time in the end, I'll also give a few quick updates on credit surcharge issues. The first up is B2C distribution. And what I'm calling B2C distribution is a payments model that's intended to solve the challenge of a company, nonprofit, or government entity that needs to distribute small payments through multiple payment methods to numerous different individuals. So Nicole, could you talk a bit more about the challenges your customers face in distributing funds to consumers, and what is it about this that's so hard and they need help with?
I think at the end of the day, it really depends on the use case, because there's such a wide variety of industry verticals, and just whether you're distributing the sheer number. Is it a small group of individuals, or is it millions, tens of millions? Also the costs involved, everyone obviously has a treasury group and does do money movement of their own, but sometimes they prefer to outsource that. If there are any kind of tricky AML issues, sometimes they just want someone else to manage sending of the money and managing that kind of individual relationship. The other issue I'd say is that everyone has been looking for alternative ways to distribute outside of checks. They are expensive, and there's a lot of kind of unclaimed property requirements that the originator or the corporate sponsor has to deal with. And so they really want to outsource that as well and find a cheaper, better, faster, more consumer-friendly way to distribute funds. Income has a variety of different relationships, existing relationships that also provide unique opportunities to do disbursement. So for example, we have one of the largest retailer networks, US and globally. And, if you wanted to, let's say, have a small cash out disbursement, let's say lottery or gaming or utility refunds or some other small dollar amount, it might make sense for those people to say, hey, let's say go to a CVS or to a Walmart or any of the other places that Income has connectivity, and you can receive it in cash. And then obviously another big play that we've been in for years and years is card products, and disbursement through card programs is also something that we excel at and that other people want to take part of. And then I'd say the fourth kind of model is, because I think I kind of went to traditional ACH to your bank account, cash out kind of at a retail on a card. And then another fourth one that we've kind of been getting into is kind of similar to the ACH, but instead of really having to manage that person's bank account, maybe going it through a different alternative means, whether that's like through a Zelle network or through a ReadyLink repowered network or some other network to make that easier, faster, quicker. So those are the kind of the challenges, and that's what we've been trying to alleviate for our customers.
Awesome. So as Nicole's been explaining, Income and other companies have developed B2C distribution payments business line intended to assist these types of clients with moving this money out to consumers. And, like she said, several different variations or payment methods involved: ACH, check, prepaid card, others. Nicole, can you talk maybe a little bit more, whether high level or otherwise, in terms of how you work with your customers operationally? What do the relationships look like? What does the funds flow look like? How does that all work out in the end before it gets to the ultimate consumer?
So we try to provide, as I said, kind of mention these 4 or 5 different options or buckets, and there's more too, but we try to make a customizable solution for a particular, we kind of focus on industry, but then we also, particularly for that client. So let's say a state lottery wants to have different ways of doing lottery winnings disbursement. We could put that on a card. We could, do an instant Zelle transaction. We could do a cash out through our retailer network that may not be. So we do two different ways. Sometimes we do it where we don't use our MTLs, and instead, like the lottery has the agency grants to us and our retailers. And there's usually there has to be an existing relationship and an agency grant from that license to the retailer. And so we can do cash disbursements that way, whether it's through like the lottery's kind of POS hardware system or whether it's through ours or our partners. Then there's the other kind of expanding that network. Again, going back to what is Income's one of their main assets is we have this incredible retailer network. So there could be lots of retailers who maybe aren't lottery partners. They're not already contractually with that lottery, and they're not an agent. And that's where our MTL would be in use to take the funds and do that kind of cash out disbursement through our retailer. In that instance, they would be acting as our authorized delegate of a money transmitter. So that's just one example, but obviously, it's so dependent on what they're looking at. But some of the verticals that we've, that we're in and we've been evaluating are, gig worker payouts, a lot of kind of either utility or small kind of, you have a little deposit that they need to get back, or you overpaid your health plan and it needs to, reimburse you. We've got, tax refunds and other different types of government fund disbursements. We have not actually dabbled in college cards much, but that's always something that we're looking at. There's also, another method. Again, we wear many different hats at Income. There are some instances where we're really not, even in the funds flow. But we are, for example, a processor, and like we're powering a program that is like a payroll program where its main utility is that people get their wages, and it's usually hourly wages, but they get it the same day. So as soon as they do that daily shift, they immediately get their funds versus having to wait 2 weeks. So, every model is different depending on if we're in the funds flow. if the originator or the corporate sponsor, whatever you want to call them, whether they have some sort of authority to disperse funds. So in the lottery example, they could do it, through agents. Whether we're using another FI partner, such as an issuing bank, for a disbursement card program. In that instance, we may or may not be in the funds flow. And if we're not, it's really not our MTL. We're more of the program manager or processor in that instance. So I think it really just depends on, there's a lot of different factors. Is there any other specific questions? Did I cover that pretty well?
Oh, you did, and in fact, you've teed off one of our next set of questions here. Astute listeners on the phone will have heard Nicole use the acronym MTL a few times there, which is Money Transmission Licenses. And in fact, we've already got one question in the comment box. Does the B2C model expose you to money transmitter issues? In a word, yes, or at least potentially, depending on how the funds flow works. And so for everyone, for background, money transmission is a regulated activity at both the federal level and in 49 states and the District of Columbia. It involves, the definition of money transmission is receiving funds for the purpose of transmitting them. And folks with some experience in the space already will probably know that many states and FinCEN provide an exemption for companies that are acting in a model where they can say they are the agent of the payee, where you are in a B2C distribution model, you are working for the payor, you're working for the sender. And so some of those exemptions that often are used in money transmission models may not be available to you. So Nicole, Incom, as you said, is a licensed money transmitter on a nationwide basis. And I think you talked a little bit about how the MPLs support your business model. Can you talk maybe a bit more about what the specific triggers are and how you think about when you are and are not acting under the authority given by your money transmission licensing, and how you work with state regulators to get them comfortable with what you use the license for in your various different business models?
Now, this we could talk about for hours, honestly. And I'm going to be a total lawyer here and give a disclaimer that says, I do highly recommend for any of you out there, if you are embarking on a new program, like hire Venable, hire someone who can really give you an extreme analysis for that particular program, because there's so many variables. But I'm going to give you kind of what I would call a question flow that we use internally for every new program. The first is you've got to ask about the funds type. And I know right now we're talking B2C. And in most instances, that means it's going to be consumer owned funds, right? That's kind of what we're talking about, B2C payments. But occasionally you can have a disbursement model where you're providing funds to individuals, but it's not consumer owned funds, it's corporate owned funds. And so for, one example, we have an OTC health care plan kind of card program where people can use corporate placed funds that are for very specific things, right? Like if you go get a wellness check, we'll pay that. Or if you get an eye exam, or different things like that. And in those instances, though, if they don't get those particular things, and in that particular program, we run our own network of private merchants. It's leveled down to the SKU level, and if those funds aren't used for that particular thing, we deny the payment, and we at a certain amount of time, they don't have those funds anymore. So in that instance, you don't necessarily, that wouldn't require MTLs because you're not dispersing consumer funds, and it's just a different type of program. But then most other instances, there probably will be truly consumer owned funds. In that instances, you've got to ask yourself, like you do for any kind of payment activity, what's the funds flow? Always goes back to the funds flow. If you're not in the funds flow, then you probably don't, I'm going to go on a limb and say you don't have a money transmission problem. There are a few states that are kind of like, well, if you market it, then you still may need to have an MTL. But I found by and large, those are pretty low risk. So you still may need to do a couple things there, but you should be okay. If you are in the funds flow, then there's still, and let's talk about, okay, if you're not, how can you do it so you're not in the funds flow? Because you're like, well, I've got to be in the funds flow. This is what I'm providing. Well, you could have programs where, let's say a disbursement card program, where you tell the originator or the corporate sponsor, you don't put the funds in Incom's account, just put it straight into the bank issued account that we have set up for this particular card program. And then it kind of bypasses us. And, then we wouldn't have to use our MTLs in that instance. But if you are in the fund flow, right, you can't get out of it, then you've got to look around in the ecosystem of that payment and say, are there any ways that we can utilize an agency appointment of some other regulated entity? So I've already mentioned how lotteries have powers under their state to, essentially disperse funds through their own agency appointments. And so you wouldn't need to be an MTL in that instance. You would be acting as an agent of that lottery. If you have a retailer or some other third party, they would also have to be an agent. So that's a bit of a limitation there. If you want to kind of do it all yourself and not have the lottery or whatever entity that is contract with every single one of your outflows. There's also, if you use a bank in some capacity that is willing to take on responsibility for this program from a regulatory perspective and willing to kind of like set up a trust account and have like terms with the consumers and kind of otherwise take responsibility, then you could also avoid having, needing MTLs in that instance. And then I'd say the last thing is kind of looking at the exemptions, right? So there are pay agent exemptions that more and more states have been adopting over the last 5 to 10 years. I can't remember the most recent 50 state survey we've done. I mean, we have done it, but I can't remember if it's like 25 states or 20 states or 30, but it's a lot more than it used to be, but it still doesn't get you everywhere. So that's, again, one of the limitations that, still wouldn't solve every single state. And then the last, if you really do need to use your MTLs or you need to get MTLs in order to do a certain part of that program, then, just what we do is learning how to get your MTLs is another whole topic. So I'm not going to dive into that. But once you do have your MTLs, if you want to do it different, what we do is a notice of new business activity with all of our states. We send out saying, here's kind of the form agreement that we're thinking of using. Here's our AML program and how we've modified it to account for this. We're going to be KYCing the individuals. We're going to be doing like a due diligence process on the corporate sponsor, making sure that any specific laws for that particular industry are complied with. So payroll is a great example. Obviously you got to look at the state wage and hour laws, to comply with that. And then, in different aspects about why you're, hitting the two buckets, which is consumer protection and, money laundering kind of prevention. And so you kind of explain what you're doing and why you think it's the right way. And then you send it out all 50 states. And if you're lucky, you get a couple of responses, a couple questions, and then you're on your way. Did I hit everything?
That it was both comprehensive while also we've enticingly only scratched the surface of money transmission. So glad everyone is at least kind of on notice that money transmission is certainly an issue here. Nicole also helpfully touched on her bank partner arrangements there in terms of how Income works with some of their issuing banks and others, whether to move money or to work with them, and that impact that has on the money transmission licensing. So just real quick.
There is one more thing that your last bullet pointed out that I don't think I actually touched on. We haven't done this model ourselves, but I have heard that the last bullet was like sponsor banks. So if you think of sponsor banks not in the card program issuance perspective, but in like accessing Zelle, ReadyLink, Repower, like alternative payment networks to do like real-time or near real-time payments. I think that some of them would, again, you could maybe bypass yourself and have the corporate sponsor just send to that sponsor bank that's like getting you sponsored into the network to access that real-time fund. Or they may be comfortable like appointing you as an agent or something, or there may be some way that you could set that up so you don't need MTLs as well, but we haven't personally done that.
In addition, just wanted to mention some other examples of laws that may affect this model, including privacy and data security, where you are obtaining the information of the consumers to whom payments are being sent, additional regulatory concerns, Electronic Fund Transfer Act, Regulation E, UDAP, escheatment. But we're going to keep on rolling along today. But if anybody has additional follow-up questions on B2C distribution, please let us know or email any of us after the presentation. So next, we're going to talk about marketplaces. But before we jump into that, I'm also now going to give out the CLE code, which is Business 2020. Once again, for everyone out there that needs CLE credit out of this, the code is Business 2020. So what do we mean when we use the phrase marketplace? And in the payments industry, this term gets used a lot, both in the sense of, let's say, lowercase m marketplace as an e-commerce platform that connects cardholders with third-party sellers, as well as a capital M marketplace that exists for Visa rule purposes that we'll get into in the next few slides. So Dan, can you tell us a bit more about your understanding of the term marketplace, how it gets used, and how does MindBody approach payment processing?
Sure, yeah, I like to think of the word marketplace as overused. I think of it like how people use innovation, you can use marketplace. I think some people look at it as like a four-letter word, like software developers think of integration, right, as a four-letter word. But I also think it's underdefined and kind of like omni-channel, right? It's one of those things that people like to throw around and they don't have a lot of true understanding of where the lines are drawn and what that means from both a legal capacity, but also your responsibilities from a risk capacity, your responsibility to your acquirer. It's very different. So at MindBody, this is something that we've had a marketplace, if you will, where consumers use our service to find businesses to visit. So in a very common sense, we are an aggregator of businesses that will be the actual place that a consumer consumes, right? And we are providing the gateway, in a sense, to those businesses. But that environment has existed longer than the evolution of the payments models that have been born to address them, right? So when we say marketplace, we've always, the birth of our business was around the idea of being what we call a two-sided marketplace, where we sell software to businesses. That's our primary business model. And then we then sell those businesses to consumers, right? So it's a triangulation that we approach in our business model. But then as it applies directly to payments, we have different models as these things have evolved. Our historic model was always that while we may be the location or the software or the app or the platform where a consumer finds a business, we did not get involved in the transaction. So in many cases, what we would do is we would expose our businesses through our app. A consumer would book directly with that business. And when the consumer looked at their merchant statement or so their credit card statement, the business is what appeared. And that serves the overwhelming majority of our use cases. As things have evolved and we've become bigger in the aggregation space, we have contemplated and we've looked at models where MindBody is the transactor. And there's a reason that we look at doing that, but it really introduces a lot more complexity and a lot of things that we have to be extremely careful.
All right, so now we're going to dig in a bit more into this distinction between what types of companies should consider themselves or consider themselves merchants, and what's the difference between being a merchant and being a marketplace. And just, from a very high basic level, the merchant in the transaction is the company that is selling the goods or services to the consumer. They set the terms and conditions of the sale, the return, the refund, maybe the warranty, and they're processing the transaction through their own processing relationship with an acquirer or processor. Whereas, let's say a marketplace, like you had suggested, a platform that's connecting purchasers on one side, sellers on the other. The marketplace may set some terms and conditions that are uniform to the platform, or there may be others that are seller specific And then, maybe the marketplace is involved in the payment processing, or maybe it's not. So, Dan, can you talk a bit more about that distinction? And also, I'm interested in hearing you discuss this concept of merchant of record that is also out there in the marketplace, and the degree to which it blurs distinctions between merchants and marketplaces, and what you may have heard from any of the networks on conversations about those issues.
Yeah, there's a lot to unpack there. I think one of the most important things, I'll say how it applies to our business and the difference of these two models, is if you go down to that third bullet, this is a really important point for us, which is, imagine, at MindBody, we aggregate 60,000 businesses and then expose those businesses to consumers who are looking for wellness activities. But to assume that we can set the sale, return, refund, deposit, no-show fee, cancellation fee policies across all those businesses that's a huge assumption, right? And it's also a large technical burden, and it's a massive customer service burden. That's very different than Uber, who can set those rules, for example, for all their drivers who are in their marketplace, because that's how they started. That was the model from the beginning. We were first a platform for the businesses that use us, and then we just chose to expose them. So that is a real driving force to why we allow the consumer to interact, or to transact, if you will, directly with the merchant. But there's limitations then in what we can do with some of the inventory. So as we've looked to the marketplace side and shifting to that model, you start to cross some blurry lines. So you don't know what side you sit on of those blurry lines. And this is where, I may be the only non-lawyer on this panel, so I'll just give you kind of the less legal perspective. It's not that easy to figure it out. Nicole, I want to go back to something that you said, which is hire somebody who knows this, right? Because hire your Venables or the like, because the lines are blurry. And what we found was, okay, we do considerable transaction volume. Let's go talk to Visa on this topic. And this is where it gets really interesting, in my opinion, because you go and talk to Visa, and what they will do is help you interpret the intention of the rule. And so I'm saying that way on purpose, which is they will say, this is what is meant by this restriction or this rule. What they won't tell you is if your model is in compliance or not. That's my experience, where they'll say, well, this one's a little tricky. I heard that a lot. And my response was, I know it's tricky. That's why I came to you. You're the card network. And what happens is it's a little bit of a three-party involvement, because it really involves the acquirer in this case as well, and what they see as accepted behavior in how that money is being moved, what's represented on the credit card statement, what's represented on the merchant statement, and if they feel it's going to set off an alarm. Because one thing that I think some people maybe misconstrue, Visa and MasterCard are not watchdogs. They're not out there sitting looking for people who violate this. It's when things come to their attention that they believe is misrepresenting the model to the consumer that they take interest. But they're not sitting there like watching every transaction saying, oh, that one runs afoul of our restriction. But you don't want to put yourself in a position where retroactively you're in a lot of trouble, right? Because that could happen, and it has happened. And there's a lot, I can guarantee you, Evan, there's a lot of businesses flying under the radar right now of what's probably not following the guidelines. So, we do hire counsel for these types of decisions. We do work directly with the card brands. We work very closely with our acquirer, and we have a version of a marketplace model where we explore being merchant of record. But we are very transparent about it. And there's the only reason that we want to be merchant of record is if we're adding some service that is additive to what the merchant would add if it was a direct transaction. That's kind of our filter, right? Which is, if we're just selling a spot in a spin class direct from a business to a consumer, we're not adding value to that. But if we're potentially selling to that consumer the ability to transact at multiple locations with a credit from MindBody, that's a different scenario where we might be able to have additive value. So when we make these decisions, we step back. We talk about what are we trying to accomplish, what's our goal, and then we just stress test it and pressure test it with third-party resources to make sure that we're doing the right thing for the consumer and for the businesses we serve.
Thanks, Dan. Nicole, does this merchant of record concept come up for income at all, or is this something that you guys haven't had to deal with?
It does. We've had, talking about, I think to Dan's point, this has been around for quite a while. We had an acquisition many, many years ago called Zvex that was essentially a, e-commerce platform where consumers could come and buy, lots of different digital and plastic, gift cards and gaming things and all sorts of stuff. And we were not, taking title to the goods and services, but we were the merchant of record and then paying all of these people in the back end. And so you kind of look to like iTunes and Apple and like Google Play and like those different types of quote unquote marketplaces. And we ended up starting to look at the legal issues, and then we really we had decided that we probably did need to start moving it under MTLs and kind of doing more of a regulated activity. And then it just wasn't really that viable. So we ended up shutting it down before we did all the heavy lift of putting it in that mode. We've also, so that was kind of one where we really were the operator of it. Then we also have had programs where there are marketplaces who really do all the legwork. It's their programs, they've come up with this solution, and then they find themselves in a bind, and they don't want, they either can't get the MTLs, they can't get them quickly enough. And what we've done is and this is in concert with our regulators, because we have a lot of other business in our MTLs that make us a lot more money. So, you have to be very careful of what you do, but what we would do is take over the payment aspect for that. And so it's not a rental license. It's truly, we had to kind of have oversight and control of the program. We would have to, we did it kind of it was a bit onerous, frankly, but we had to have direct contracts with all the sub merchants. We had to do our own diligence on all of them. We had our own AML program that we made the marketplace kind of chin to. So it's a lot of work to do it the right way, the way that the regulators expect you to do. And then frankly, as Dan said, there's so many marketplaces who are operating not in compliance that it just becomes kind of burdensome for the marketplace. And so I think it's really, until you have a ton of scale, I think a lot of companies, and frankly, rightly so, are just taking the position of well, let's deal with this later. Until we really have big scale, no company is 100% in compliance with all laws at all time. It is what it is. And so, when you're just talking credit and debit card acceptance, probably not the highest risk activity, right? If now you start, doing anonymous cash in, then you probably have a different risk profile there. So.
And Evan, just a quick comment on that, Nicole. I think you said a really important thing, which is this whole thing is about what's your risk exposure, and then how do you mitigate that against your business model, right? And to your point, scale is a really important factor here of when you have to make some of these crucial decisions and when you have to engage even third-party counsel and things of that nature. But at the end of the day, it's risk management. Is this a risky enough activity for me to lean into it or not? And to your point, it varies based on the types of financial acceptance that it changes your exposure. So that's why it is blurry, and it's hard to make some of those decisions.
And just for the people in our audience, I'd say again, go talk to the Venables and the law firms, but your risk profile is going to depend on whether it's credit, debit, other aspects like cash or crypto. That's going to give you a different risk profile. Also, what industry are you in, right? Another is whether the goods and services are provided to consumer immediately or whether there is a delay in delivery. And so then the consumer obligation really hasn't been satisfied. All those things are going to make a difference in how regulators, what risk profile you would get there, I think. And then frankly, whether your consumers are happy, if you don't have a lot of complaints, no one's really going to probably come looking at you. And if you're not doing dumb things like taking the funds and using them for your own business purposes at times, like just all these things that are pretty common sense, frankly.
It feels like, sorry, I know we need to move on, but it feels right, Nicole, that
Yeah.
look, follow these best practices and you're going to be okay. Don't do these really glaring bad things. You mentioned a couple of them, like when are you accepting money versus when are you delivering goods? That's a big one. And the other one of if you do anything with that money, and while it's in between those two things, expect consumer complaint and then a red light to be shown on your business. So it's just like do it under the best practices, and you're going to most likely have a better experience both for the consumer and your business as well.
All right. So obviously this question of merchant versus marketplace, very murky, a lot of things to think about here. But just to make this slightly more excruciating, we're going to add one more level of complexity on top of it. So let's assume that you have determined you are at least a lowercase m marketplace. And now you have to figure out how are the payments on your platform going to get managed. I've set out 3 different models here. There are probably others. One is a model in which the marketplace acts as something like a referral or an ISO for third-party payment processors. And now to make things very confusing, the marketplace may choose to be a capital M marketplace for purposes only of the Visa rules, because only Visa has decided to make a separate category of processing entity called marketplace. Or you could potentially be a payment facilitator. Most marketplaces, in my experience, do not typically choose to be a payment facilitator, which is more, in my mind, a focus on being a payments company than on being, let's say, an e-commerce company. But potentially you could do it. And then for purposes of networks that are not Visa, if you're a marketplace for Visa, you may be one or the other or something different for a different network. So Dan, can you talk about which one of these, or maybe there's more than one of these, most accurately describes the mind-body model? And if it's not marketplace, what factors went into a decision to not be a marketplace for Visa, but to be a marketplace generally, as you've described?
So I'll just say yes. And what I mean by that is, I think part of what you're also describing here is the evolution of payment models, right? So it's not that all 3 of these were on the table at the same time, and you had the luxury of picking one and saying that's what we're doing. As the payment models have evolved, the complexity around which of these, in which scenarios you play changes, right? So our most common model is the ISO model, where we are reselling core processing functionality and acquiring functionality to small businesses on behalf of the acquirer, but we're setting things like pricing and we're taking on risk. And that's, they're processing traditional transactions. You walk into a salon, you put your card down, it's an $80 payment, and it runs through our software, through the rails of our acquirer, and we are involved in that transaction. We take risk if there's chargeback. We provide interfaces for things like charge management, voids, and refunds and things like that. That's our traditional payment model, but that's B2B. When we throw in another B, or when we throw in the C and we're B2B2C, that's where it gets more complicated, right? And that's where we have a real combination of these 3. And what I mean by that is there's a model where we simply facilitate the transaction between the consumer and the merchant. That's still an ISO model for all intents and purposes. It's not a marketplace model because we're not directly involved in the transaction. That being said, there are other models, and it starts to get really tricky here, where we help to facilitate things like fees that go through franchisors and then are distributed to franchisees, where a percentage of sales may be held for a franchise fee. We get into payment facilitation in that area, right? Or we're facilitating different payment models. That doesn't still qualify us as a marketplace in the Visa regard. So what I would say right now, our payment model is the referral ISO model, the payment facilitation model, but it's circling the marketplace model. And that's why we are engaging in the direct conversation and engagement we are with the card brands to say, look, we're getting pretty close to checking a couple of these boxes. Let's make sure that we're on the same page.
Makes sense. All right. So we had a couple of other items on marketplaces. Happy to take questions on AML and underwriting marketplace model if we have time at the end. But I'm going to go ahead now and skip to buy now, pay later. Andy has been waiting very patiently. Thank you, Andy. So now we're going to get into a consumer credit area. Andy is the expert here at Venable. And so we're going to talk a little bit about buy now, pay later. And just let's say writ large, buy now, pay later is popular model in the retail credit space. Typically, the options are offered at checkout and allow a consumer to obtain one-time extension of closed-end credit for a specific purpose. And buy now, pay later is often offered through one of two major models, a retail installment sales agreement or an installment loan. Andy, can you talk a bit about, the model overall, these two methods of accomplishing the model and the differences between them?
Yeah, sure. So happy to. I guess just to frame it up, what is buy now, pay later? What exactly is it really a new phenomenon or not? I mean, really, all essentially it is it's an ability for consumers to make purchases that they don't necessarily have the cash on hand to make at the time they're buying it, or they do, and they just want, basically want to keep their cash reserves and pay in installments over time. Historically, that's been around for a long time, but it was done through other means. Like at one point in time, there were layaway plans at stores where you would just go into the store and you may have store credit where you're making payments back to the actual merchant that you bought whatever it is you're purchasing from. My generation was more credit cards. Everything was credit cards, and you would carry a piece of plastic around and use that and get rewards points and so on and so forth. But I think as time has progressed and more business is done online specifically, there's less of an inclination to carry credit cards around and to provide credit card numbers to merchants when you're making purchases and so on. The reason I think for that is credit cards they're typically bank issued. There's a process to getting one. It's not that difficult, but there's an application that's fairly intrusive that someone has to go through, and it's not something you can really do on the fly. Another model that was around prior to buy now, pay later was co-branded, white labeled cards, whatever you want to call them, where you'd be standing in line at the store, you're buying your clothing, you're buying whatever it is you're purchasing, and they get you to enroll in a credit card through their partner bank or whatever it may be. And I think in terms of the online flow, what we've seen is an evolution of what's called buy now, pay later. I think initially it was going by point of sale financing, where there's an easy checkout process. You're going through, you're buying whatever it is you're purchasing, and there's a button you can click for a payment option where there's a relatively short, easy, seamless transaction that you're completing, and then it's paid off in X number of installments. That's typically what it is. There's several different ways to do it, which is what Evan's alluding to on the slide. And we work with clients who do it all sorts of different ways, but typically you either have a model where the merchant itself is still the creditor. That's what says here, a retail installment sales agreement or ERISA. That can be open-end credit or closed-end. It's usually closed-end, and basically you're completing a credit sale with the merchant when you buy whatever, whatever it is you're purchasing. What typically happens there is the contracts are then aggregated and sold to what's called a sales finance company, who then services the debt. I think a big thing to keep in mind for buy now, pay later is the merchants want to complete transactions to people who don't have a credit card, don't want to pay in cash, whatever it may be, but they don't want to be in the business of becoming loan servicers. So that's a big driver in this model and why third parties are involved. That retail installment model, that the merchant is actually the creditor on paper, but for all intents and purposes, the underwriting is being done by the sales finance company for the most part. They are the ones who are going to be servicing debts. They're usually the ones who are providing disclosures and forms and everything else for the merchant to use. And then another model, which we've seen more and more of, is really what you think of as a direct installment loan to finance a purchase, or even open-ended credit card that can be done very quickly through an online checkout flow. In the past, again, this model would have been what I call BYOB, bring your own bank, where you would show up with an offer from a lender, whatever you're buying, and finance it that way, where the lender proceeds would go to the merchant. Here, there's a direct partnership. So you may have a finance company. They're often fintechs, so someone like a firm or a company like that that's in the checkout flow, which is an option. You click on it, you apply, and then you get an installment loan, and you're enrolled to pay them back. They advance funds directly to the merchant, and so on. Obviously, there's different legal issues with each of these, and another model which isn't mentioned here that I think bears mention is that credit card concept is a little more seamless with less conventional cards, what are called single-use cards, where you basically have an account that can be used with a particular merchant or store. And it's a revolving account that you can use and reuse, but you go through the same type of flow for that as well.
Thanks, Andy. So you had mentioned some of the legal challenges here, and this is not an exhaustive list by any means, but state licenses and registrations could be involved. There are Consumer Financial Protection laws, Truth in Lending Act, Equal Credit Opportunity Act, UDAP concerns, as well as you mentioned, some buy now, pay later companies may have arranged to work with a bank partner when they offer this credit through their program. So, obviously we won't be able to make it through every single law or challenge that could apply to this model today, but can you talk a bit about what are the biggest challenges or the biggest concerns that your clients face when dealing with this model, whether they are merchants that are considering a buy now, pay later program, or are finance companies themselves to which these requirements might apply?
Sure. So, and I don't necessarily think of them as challenges or concerns. It's just that there's whichever path you choose, there's different laws that have to be navigated, and you essentially have to build compliance around, depending on who you are in the transaction and what it is exactly you're planning to do. On the merchant side, the easiest is obviously just partnering with a third-party lender who is effectively going to take a loan application and give you money, right? And that's fairly easy for a merchant to deal with. The economics aren't always as good there, because you're depending on the pricing from the third-party lender. The merchant may have to subsidize the purchases, right? They may have to basically give a discount to the lender, the lender's funding transaction. The merchant basically will bear some of the costs the consumer might actually, in normal circumstances, bear through interest or other fees. For the what's called the retail installment model, the retail installment assignment model, a good comparison is indirect auto lending, where the merchant itself has to basically be registered in some number of states as a retail installment seller. There are 2 states, Florida and DC, that require an actual license that the seller has to go through an application process, which can be lengthy and time consuming, and you become a regulated finance company, and not everyone wants to do that. Depending on the scale of your operation, it may well be worth it. But that's one of the first things that we usually work through with clients is, are they willing to take on that level of responsibility? And then, there's some additional tricks and traps, whatever you want to call it, because most merchants are not set up to be creditors. They don't want to be creditors, but the truth in lending disclosures that are provided, the legal contracts, all of these state notices that go on a retail installment contract are technically the merchant's responsibility, because the merchant's the creditor. And one of the issues that I've seen is they're getting that information from whoever is going to buy the contracts. They're of course making reps and warrants when they sell contracts that everything's done in compliance with law and so on and so forth. But they may have licenses or registrations that they need. If there's errors on the forms or whatever, they could technically have an obligation to buy those contracts back if they go bad. And to some degree, granted less than being a lender, but to some degree, retail installment sellers are regulated. And so that's, those are a few of the issues there. On the direct financing front, where you're basically working with an installment lender, those often are banks. And there's a separate, this slide says bank partner arrangements. There's a separate set of considerations there. If you're a fintech company, what we call a non-bank fintech company, and you want to be a buy now, pay now lender, and you want to partner with the bank, there's a whole, basically a complex transaction that needs to be entered into between the two parties. That's typically done for usury purposes and license purposes and so on, where the non-bank company is forming a partnership with a federally regulated depository that's exempt from some of these requirements in order to be able to charge more interest than some of these states allow just for state licensees in order to avoid being a lender and so on. But those can be complicated arrangements where the non-bank company has to basically bear some of the cost and make sure that it's in the interest of the bank to do the loans that are at issue. From the merchant standpoint on that model, it's fairly simple. One thing that I have seen that's come up and I think can be tricky, or two things I would say. One is there's often some level of pre-screening for creditworthiness. That may be pulling credit, pulling what's called a consumer report, which implicates the Fair Credit Reporting Act. That it can be tricky when you're doing that for multiple lenders, when you're basically running someone through what's called an application waterfall to choose a financing provider for them and so on. But essentially, you have to have a permissible purpose in order to pull credit. There's limits on what you can do with that information once you get it and so on. That's an area that I've seen merchants and lenders alike and fintech partnerships and alike get in trouble. Another is if you are partnering with someone who is either in a bank partnership, there's a bank behind them, or directly with the bank for this financing, you may be taking on, if you're the merchant, KYC, know your customer requirements for the bank. We've seen some actions where even the Department of Justice has been involved in potential bank fraud if the wrong information or incorrect information or intentionally misrepresented information is being transmitted to a federally regulated depository. There's some very serious anti-fraud statutes that can come into play there. So that's another area that that can be tricky depending on how you do this and who you're partnering with. Then there's the normal the normal disclosures, fair lending laws, UDAP, which is deceptive marketing practices and so on. Those all come into play too. There's bodies of law around each. You're dealing in the world of consumer credit, so there's a lot to it. It's not just your standard FTC UDAP where don't be deceptive and you're okay. There's specific ways that you have to disclose interest rate versus APR and payment schedules and so on if you're advertising on behalf of any of these companies or if you're doing it under your own flag yourself. And one of the other issues, just it's a little bit of an aside, but I thought it was worth mentioning. Some of these buy now, pay later arrangements are deliberately set up specifically for small purchases like clothing, where you may only be talking about a couple of $100 in credit. They're deliberately set up in a manner where they're intended, at least in theory, to avoid state license requirements and even statutes like the Truth in Lending Act that only get triggered if your loan, the credit you're extending, bears a finance charge, which they often don't, or is payable in more than 4 installments. So we've seen some lenders set up arrangements where they're extending 0% credit for payable in 3 installments, and therefore they're exempt from some of these laws. But that, as I think others have alluded to, and in this panel, needs to be done carefully and with full consideration of state law, not just federal. One of the issues I know Evan and I have worked through with clients is you're okay under federal law, but the state has a broader definition. What's your answer there, and so on. So there's really a lot to this. Honestly, it could be its own hour-long or 2-hour-long panel, but there's a lot to it. It's a really interesting area because, again, this is increasingly how electronic commerce is being done.
Andy, thanks for that. Extremely informative. And like you said, probably any of these business models could have been their entire discussion. Next year, I will hog the entire payments boot camp by having a 3-hour session on various different models. So I'm coming in hot to this Q&A, but just real quick, surcharging. I just wanted to mention, I know many in the audience have probably been following surcharge laws very closely. At this point, California, Florida, Kansas, and Texas surcharge prohibitions have all been held unconstitutional and unenforceable. Maine and New York have effectively been recharacterized as disclosure requirements. The Oklahoma AG has said in a public opinion letter that were the state surcharge prohibition to be challenged, it would likely be found unenforceable. And most recently, just this week, the Colorado legislature submitted a bill to the governor that would legalize surcharging, leaving only Connecticut and Massachusetts potentially as the remaining states with a surcharge prohibition on their books. So we've got about 2 minutes left. If anybody has any questions. Looks like we have one final one. I have not received any others, but the last question I received is, how do regulators view the B2C distribution through non-retail, non-financial entities where it's not the entity's core business? Is this still considered money transmission? And recognizing that you can't provide legal advice, obviously, Nicole, do you have a thought on this?
So this has interestingly come up in one vertical for gig payments, or gig worker payments. You've found a lot of employers not wanting to, wanting to really limit their liability there, right? And so they can go down like kind of two paths. And what I've been seeing is that, you can either go the traditional like payment, like true payment company, payout method. But then that payment company is not really going to be responsible for the gig worker. They're not going to file the W forms. There's all different types of forms depending on gig workers, but they're not going to be doing that. They're not going to take responsibility. So then the other model is kind of like a staffing solution model, where these staffing companies will, really kind of provide that barrier from an employer-employee liability perspective. But then they also start, kind of taking on the payment aspect, and that what I've heard is that state regulators have started to go into some of these really large staffing companies and saying, listen, you are essentially doing disbursements. You're taking funds from the employers and then you're paying out these gig workers. It's hop, skip, and a jump. You're touching it for, half a day and then you're remitting it out. But you are, you have a funds flow problem. And so I don't know how many regulators are going to challenge that, but I do know that there have been questions and, if not consent orders, there have been definitely inquiries so far. That's just one industry, and I'm sure, I don't know if that even touches on the fact pattern that was asked here, but that's the most recent example I could think of. So I think the answer is,
Thanks.
As always, potentially. Maybe, maybe not.
Sure. Right, and to add to what Nicole is saying, I would caution anybody that is in a line of business, even one that is not a traditional payments business. The definition of money transmission, again, in almost every state is receipt and transmission of funds. So if you receive somebody else's money for the purpose of sending it to somebody else, even if it's not your core business, I think it's worth thinking about. And the phrase in a money transmission statute, engage in the business of money transmission, should probably not be interpreted to mean, if this isn't my main business focus, this will definitely not apply to me. That term can sometimes effectively be read out in the way that I have seen at least state regulators approach the question of whether or not somebody is involved in money transmission. So we are now at the end of our program. Thanks everyone for attending today. Thank you to MAC for co-sponsoring the Venable Payments Bootcamp along with us. And for all of our participants, please be on the lookout for Venable's Payments Toolkit, which will be coming out shortly and is going to be sent to everybody who registered for the Payments Bootcamp program. So thank you everybody, and look forward to see everyone next year. Take care.